Welcome to ETF Leaders, powered by the New York Stock Exchange. Joining me today is Jeffrey Sherman. He is Deputy Chief Investment Officer at DoubleLine. Jeffrey, great to see you. Thanks for joining me.
Yeah, good to see you again.
Thank you. All right, so tell me, what are your expectations for the markets for the second half of 2022?
Yeah, I think what we've seen here is that there's been a big repricing of markets, whether it's fixed income, whether it's equities, that there's been a lot of repricing to the downside. And I think a lot of that is really driven by the inflation front. And there's some really concern about how the Fed is going to react to this function, how aggressive they're going to be with their policy. And we know that they're going to hike interest rates. They're on a really strong path to do so. But the good news is, I think that a lot of the bond market, at least, is priced for that already. So you look at kind of what's implied from the Fed futures market today, it says that we're probably going to see the Fed hike another 200 basis points throughout the rest of the year. So as long as the Fed stays within those guardrails, I think the fixed income market is pretty attractive at these levels. We're now being able to buy portfolios that are diversified with credit, rates, all of it together, and you're yielding in the mid to high 4% range today. So that's significantly more attractive than, let's say, 9 months ago, where things were yielding in the low 2s. So on a forward-looking base, it looks attractive. I think the challenge with equities in the second half of the year is going to be if those bond yields are driven more by rising real yields. So think the TIPS market. If that happens, that could be a compression in multiples. That being said, the earnings have been pretty strong this year. The market has not appreciated that. There's still been the repricing of things. But I think we're setting up for people who have to have like a 2 to 3 year horizon. I think things are getting really attractive in the equity market as well. So we're getting more constructive, but it's going to be noisy until rates really settle down into a trading range. I think that's going to be the problem for financial markets and risk assets in the near term.
Okay. All right, so given the current market volatility, how do you think investors can best manage their risk?
Yeah, I think it's being cognizant of them, one. We know a lot of people were just blindly following momentum and just doing what had been working. And so I think it's back to thinking about fundamentals. It's looking at valuation, looking at things that are cheaper parts of the market, but also higher credit quality. Right, so higher quality assets, things that are more stable businesses, things that can weather the storm of rising costs, input costs that maybe they can't pass it all on, or employment costs that they can't pass along. And so I think it's really focusing on not just having broad exposure, but narrowly focused on companies that can really maintain profit margins, or at least have significant margins and allow for some of that compression to absorb that.
Okay, and what's your big area of focus for the second half of the year?
Yeah, I think for what I'm seeing out there is I still like the value trade within the equity market. I think things like financials haven't done very well. A lot of people blame the shape of the yield curve and the repricing that's taking place there. But we see in the financial markets that the housing market continues to be strong. I know people are worried about higher rates, but the banks have been able to lend in that. So I do like the financial sector as well. I think real estate is still attractive because you can get good income on the back end. If there is inflation, those real assets do well over time. So property values can maintain over that and get some of that correlation to inflation. So on the equity side, those are kind of my favorite areas. Within the fixed income market, I like real assets again. Things that can generate cash flow, whether that's from the housing market, whether it's from commercial real estate, asset-backed securities. So things that are more off the run from a traditional advisor portfolio. And obviously you need an institutional type manager. I'm talking my own book there. But there's a lot of us out there that do that. So I think there's very interesting opportunities where you can do in fixed income. You don't have to take significant amounts of interest rate risk, and you're finally getting paid what will ultimately turn into be a real rate of return that's positive.
Okay, all right, well, Jeffrey, great to talk with you.
Yes, great to see you as well. Thank you.
Thank you, and that is ETF Leaders, powered by the New York Stock Exchange.